Confirming what's been going on in the backdrop of increasing macro uncertainty, and now we're on the cusp of getting better visibility into earnings. So the value rotation trade has been maybe 10 years in the making.
Right.
You have growth up something like 324% versus 114% for value since 2009. The yield curve has an effect on that. When you saw the gyrations in the bond market, you could extrapolate that there was a technical factor pushing the value stocks up. But a change in leadership, a rotation in market factors usually presages a change in the macroeconomic environment. So if this is sustained, can we see an economic bottoming here in the PMIs, which some people have been looking for? So we're breaking into three ways to think about it. Macro that matters, also the corporate cycle and the fundamentals that we're seeing, and the consumer cycle, which is lagging the corporate cycle right here, which still looks very healthy.
All right, so that's sort of three cycles to pay attention to, Scott.
Yes.
And look, there's been a lot of confusion over the last few months about what the true state of the economy is. It doesn't help that the next Fed meeting is basically 50-50 on whether they cut rates or not. And then the Chicago PMI, Scott, this morning came in a little disappointing. So I think people were waiting to see if we might start to move more to the upside, but not today.
Well, Kelly, I tell you, I think it's going to be tough for the market to really work its way higher above, let's say, the all-time record high until we get some kind of trade resolution. You know, our outlook really is constructive. We're looking for modest growth. We're looking for just modest inflation. But, you know, the negative risks to that outcome really over the past few months have increased. And while we expect some kind of trade deal, it could easily not come until 2020. So, you know, what we've done here over the recent months, over the last 6 months really, is in a couple of different steps. We backed off equities a little bit. We raised a little cash. We basically tried to take some risk out of portfolios because here at the top end of the range where stocks really for us are pretty fairly valued, our year-end target is just a little bit over 3,000. We thought it was probably prudent given these uncertainties because let's face it, I mean, you could get positive trade news that probably push the market higher. And if you get some bad trade news where it's, hey, we're going to walk away from this thing, you can bet the market's going to be lower. So for right now, we're playing it a little more neutral.
So, Scott, Kevin, Scott says take risk off. What are you doing now? What kinds of postures are you leaning toward and away from in your portfolios?
At the total portfolio level, what we've been trying to do is mitigate the effects of macro shocks, mitigate the unanalyzable factors that are out there, whether it's political, geopolitical, trade talk. So we're focusing more on corporate fundamentals. I agree that the S&P 500 is fairly valued. I think there's a lot of market participants who would argue it's overvalued. But the reason it's fairly valued at a multiple above the 25-year history is because profit margins are so high and returns on invested capital is so high. So the warning signs, the things we're paying attention to is in the next reporting seasons, like the last three reporting seasons, are margins going down. And we've seen them maintain even a massive deceleration of earnings from high teens down to single digits. Those margins have remained pretty flat at a super high historical level. That's supporting these valuations. So trying to focus on the fundamentals, not taking the big sector or factor bets right now because we still think the corporate cycle, while decelerating, is very robust. And there is confidence in a lot of CEOs when you hear sentiment. They're buying back their own stock. They're investing in technology, not necessarily incremental CapEx, but there's a lot of plans out there to keep the companies growing and keep those margins high.